Hi, this is John Prasinos, Editorial Director of Investing Daily, with a video update for Monday, September 14. Well, stocks have skidded for 2 straight weeks. As the contentious presidential election kicks into high gear, investors should brace themselves for more headline risk. The economic and political news, well, it probably won't get much better between now and the end of the year. Certainly not between now and November 3. I expect further losses in the days ahead as the November voting looms on the calendar. Stocks last week fell for the second consecutive week amid heightened volatility. Technology stocks underwent their worst decline since the pandemic-induced sell-offs in March, leaving the Nasdaq Composite about 10% below its all-time high reached only a week ago. Take a look at my first graphic. Fueling bearish sentiment last week were worries over excessive valuations, the failure of Congress to agree on a coronavirus stimulus bill, and signs that the labor market is weakening. However, as you can see, international stocks fared better. The pandemic is further under control overseas than in the U.S., and factories in Europe and Asia are getting back up to speed. In America? Well, in America, the recovery is far more tentative. Take a look at my second graphic. The U.S. Labor Department reported last Thursday that more than 857,000 workers filed new claims for state unemployment insurance in the week ending September 5, a slight increase from the previous week. On a seasonally adjusted basis, the total was 884,000, unchanged from the revised figure for the previous week. In addition, about 839,000 new claims were filed under a federal program called Pandemic Unemployment Assistance, the PUA, which gives help to part-time workers, freelance contractors, and others who don't typically qualify for state benefits. The PUA figure showed a rise from 748,000 the previous week. The unemployment rate fell to 8.4% in August, but the persistently high level of layoffs shows that workers are still struggling and the so-called recovery is uneven. Keeping a floor under stocks has been extremely dovish Federal Reserve policy. The monetary policies enacted by the Fed since the coronavirus pandemic began in early 2020 include slashing the federal funds rate to near 0%, buying corporate and municipal bonds to buttress the credit market, and directly lending to small and medium-sized businesses. However, corporate earnings for the second quarter aren't pretty. Take a look at my third graphic. Earnings for the S&P 500 reflect a year-over-year decline of 30.2%, with healthcare the top-performing sector and energy the worst. Crude oil prices have fallen below the break-even point for most energy producers. The energy sector is a barometer for the overall economy, and the disconnect between the economy and the stock market is not sustainable. Small companies account for the majority of jobs, and they're going bankrupt in droves. Even mega-cap global corporations can't thrive when consumers are too broke to buy their products and services. But here's the good news. Our investment experts have unearthed a hidden value play in technology that's poised for exponential gains despite the headwinds afflicting the rest of the market. For details, consult my article that accompanies this video. Well, that's it for now. If you have any questions or comments, you can reach me at mailbag@investingdaily.com. In the meantime, stay invested and please stay safe.